Hello, everybody, and welcome once again to this edition of the Master of Money. I'm Steve Beeman, your host, and I am very pleased that you're joining us either here in the beautiful offices of Harvest Investment Services or joining us by Ustream throughout the internet around the globe. We're glad that you spend this time with us, and we hope that the information we provide can help you build a better path to prosperity. You know, as a 25-year veteran of financial services, I've learned a great deal from the inside of how Wall Street works. Well, it's my great honor to share that knowledge with you through the Master of Money program. And again, we hope this helps build a better, more prosperous America. And indeed, for those joining us around the world, we hope that it can be part of building a better and wealthier globe as well. So thank you for joining us. We're glad you're here. Now, we're beginning a new holiday season here in the United States, and one of the thoughts that I had over the Thanksgiving time is that as we do enter this period of Thanksgiving and holiday celebrations, maybe it's time each of us picked out just one charitable institution that we feel closely aligned to and help them enjoy some of the fruits of our labor as well. You know, one of the tenets of the Master of Money is that it is a good thing to donate and give and be generous, especially at holiday time. So we hope that as you look at your schedule, you'll find the time to review and perhaps join some of the wonderful charities around that could really use your help this Christmas season. Now, tonight's topic is focused on a very hotly charged and politically sensitive issue. Yep, I'm going to be talking about the third rail of American politics, Social Security. Now, I'm not going to take a political bent on this. That's not what we're about. We are going to try to look at it from the good, the bad, and the ugly. So if you're 20 years old just starting out, or 30 beginning a family, or 40 starting to think about retirement, or 50 really thinking about retirement, this program is for you. If you're already one of those retired folks watching us today, you may find this not quite as important for you as you're probably already receiving some of those benefits. But what we want to talk about tonight is the sustainability of it and whether people can look forward to that program for years to come. So stick around. We think this is going to be very, very interesting. Now, last week, if you joined us, we talked about hybrid annuities. These are interesting derivative instruments created in the insurance industry that give you a number of really nice benefits. We talked about, for example, how the hybrid annuity could give you the benefit of a defined benefit plan for your retirement. And we talked about how it could also give you some tax preferential treatment as well as some upside without having the downside risk of the markets. So we hope you found that program interesting. If you're joining us tonight and didn't have a chance to see that program, you can go into ustream.com and visit the safefinancial.net or the Safe Financial Network, and that will show you those previous broadcasts. So you might find that one on hybrid annuities especially interesting. Now, we didn't have a super stock for you last week. We're still working on finding new ideas, but with the holiday season, we've been so backed up, we just haven't been able to get these to you. We will be continuing that next week and giving you some more new ideas that you can use to tactically build a better portfolio. So we're looking forward to starting that up. Now, we've asked over time, and especially with topics like the hybrid annuities, we get a lot of questions. People write us directly at questions@safefinancial.org. And those questions sometimes have to do with the previous topic. They have to do with the topic we've done in prior sessions, or maybe something we haven't yet done, but people wish we would do. Well, we did get a question this week on the use of what are called direct participation programs or limited partnerships. These are offered through a number of investment advisors and very typically center around real estate or natural gas or perhaps timber or things of the commodity nature. But the question that came into us was, my advisor asked me to participate in a limited private partnership. This is new to me. I'm not real sure. What do you think I should do about it? Well, let me share this with you. First, participation in these limited partnerships or direct participation programs can be very beneficial for your returns. Oftentimes, because of the nature of them, you get tax benefits as they pass through those tax amortizations and depreciations directly to you. In addition, you might find the net after-tax returns are higher than you can get in standard bonds or mutual funds. That's all very, very good. Now, there are some things you should be aware of. In what we've all talked about, remember the day? Well, back in the day, you could actually get unlimited tax write-offs from very small investments. You put in $1,000 and you could write off $10,000. Well, it doesn't work like that anymore. Tax code has grown up and changed it so that your tax benefit on a direct participation program is limited to the amount of capital that you've contributed. So don't be caught up if someone's telling you about these extraordinary tax benefits. You are limited to the amount you put in. But with all the benefits of the programs, there's one big negative, and that's something that anyone who's invested in them has realized in the past. Most of them have what's called a lockup procedure, in which you're locked up and putting your capital in for so many years. In other words, you put it in today, but you can't get it back for 5 years. Well, that liquidity can cause real problems if during that lockup period something's happened and, well, you need your money back. I've seen this in private partnerships as well as venture capital and private equity programs where you put money in and yes, you generate the return you're looking for, but when you need it most, you may not be able to get that capital back. So be aware of the liquidity risk that you have in these programs and make sure that you don't find yourself in what's called a liquidity trap, where going forward something happens that you didn't plan on and you need that money back but you can't get it. So to our friend who wrote us, we first say thank you for writing, but secondly, talk to your advisor, find out if there are lockup provisions, find out the liquidity trap that you might be walking into, and make sure that the decision you make is based on all of the facts that are there, not just the sales brochure. So we welcome all of you to write us at questions@safefinancial.org and work with us to answer the questions that you have. Again, our goal and our mission here at the Society is to build a wealthier community, and we can only do that if we can share the knowledge we've gained as Wall Street insiders with you. So feel free, once again, questions@safefinancial.org. Now, in the geopolitical world, we frequently talk about things going on around the world that can affect you as an investor. That is our primary goal. How does it affect your portfolio? Well, this week, instead of coming up with a random collection, I thought I'd go to one article. It was published in Institutional Investor, and it focused on 4 strategic geopolitical risks that you should be aware of. I found it interesting because here at the Master of Money, we've spoken about a number of these, and you'll hear a lot of things repeated from what we've talked about in that article. The first thing they talked about was this incredibly changing relationship between, yes, Vladimir Putin and Russia and the West. It seems that Mr. Putin wants to reestablish Russian credibility throughout the world and has taken great strides to reestablish moves that, well, some people aren't very happy about. Clearly in the Crimea and in the Ukraine, they've imposed Russian will, and that's made most of the world pretty upset. Lately, they've been doing, as I've said, bomber flights in the Alaskan Air Defense Zone. They've had submarine missions off the coast of Finland and Norway. Recently, they announced, and you're going to love this if you live in Florida, they announced bomber squadron flights in the Gulf of Mexico. Yes, for the first time in history, Russia will be flying its advanced Bear bombers in the Gulf. Now, they say this while they're also running military and Navy operations in the English Channel. So we know Mr. Putin is rattling his sabers largely in response to the response of the West to his invasion into the Ukraine. We'll see where it all goes. But that definitely does affect where we strategically want to place our assets. The second thing they talk about, and again, we've spoken about this at the Master of Money, is the growing role of China and how the Chinese economy is changing. There's a lot of thought that China is building a really dangerous real estate bubble. In fact, if you talk to people, you'll know that in China, when they go out to build, they don't just build a building, they build an entire city. But oftentimes, if you see these cities that are popping up like a McDonald's on every corner, there's nobody in the cities. They don't yet know how to migrate the impoverished rural class into this growing middle class to occupy that urban environment. Well, they are building an awful lot of real estate, and that tends to lead to a bubble. So China, who's experienced enormous growth rates over the last 2 decades, they could see some of that slow down. As that happens, it will change the dynamics of the economic world. We want to watch that for a number of reasons, not the least of which is to the extent China and Russia play together, well, that puts pressure on the U.S. dollar, because it's the U.S. dollar's reserve status that is actually driving its value. And we want to make sure that we don't lose our reserve status as China and Russia begin to play these games around the world. The third thing, which will come as no surprise, is the explosive situation in the Mideast. With the growth of the ISIS operation, the collapse of Syria, and the changes in Iraq, Afghanistan, and Libya all through it, it's very difficult right now for anyone to know where this ends. We're engaged in negotiations now with the Iranians to what will in effect let them build a nuclear weapon. Well, the Israelis won't look too kindly on that. And if you believe in that little nation, surrounded as it has been by enemies, Israel may have no other alternative but to militarily respond in advance of the Iranians doing something really bad if they get that bomb. So we've got a huge amount of instability in the Middle East. That comes economically down to oil. But as I've told you before, we are now the world's largest producer of oil. So yes, we're self-sufficient. We could survive big production problems in the Mideast. It would cause prices to rise. We'd survive it. An awful lot of economies wouldn't. So that would be of major impact, not to mention the geopolitical consequences. Now, as I've talked about China and Russia and Israel tonight, it's interesting to note China is making inroads into Israel to become a very major trading partner. I've said before, China is not necessarily a friend of the United States. They're a trading partner. And they're going to exploit their capabilities all over the world to build trading with that nation. Well, they now are working directly with Israel to try to build a better relationship so that they have an inroad into a free economy in the Mideast. This could be very good for Israel as it builds support from China, but it could once again devalue the U.S. relationships throughout the world. So we want to watch that. And then finally, this article mentioned the changing dynamic between the United States and its European allies. Since the end of World War II, the United States has participated very closely with NATO to create an environment of security and strength for the Northern European nations. Well, now, especially with recent changes in the United States' stance around the world, kind of withdrawing its global influence, NATO feels to some extent like they're standing alone against the Russians and against the Chinese. So we're seeing a widening gap between the United States and Western Europe, and we're not sure that will play out. But we want to watch it because the European Union is very close to the United States in overall economic power. And we don't want to have to fight a two-front war against the Chinese and the Europeans economically. So those 4 themes written about this week by Institutional Investor work very directly into building a strategic portfolio. It's relevant, and that's why we want to talk about it here on The Master of Money. Now, in the economic world, I think one of the most interesting things I saw last week was a poll by the Gallup organization, a highly credible organization, and I'm going to put the chart up on the screen for you here, but it shows that U.S. economic confidence slipped a little bit in November, and you can see that this has really been a relatively stable thing up through September, where it began to rise very strongly. Well, that slip-off tells you that the American consumer, yes, they're optimistic that things might be getting a little better, but they're very confused by it. They see lower gas prices at the pump, and that's helping fuel a lot of consumer spending, a lot of better feeling, but they just don't feel like the core economy is that strong. Neither do you, I'm willing to say. So we've had a transitional economy. We've had a movement from manufacturing into technology, which has displaced workers. We haven't yet come to grips with that. We have a globalized economy that we haven't yet come to grips with, and we've had a lot of changes in the United States in the last 10 years. The debts we now carry are a drain on our economy. That's not a statement of whether we needed them or not. It's a statement of fact. $17, $18 trillion in national debt does drag an economy, and that's part of what you're seeing in the confidence numbers. So that will affect Christmas spending. Now, we would expect the GDP to do okay in the fourth quarter. We had a very good second and third quarter. Our expectation here at the Society is that we'll have a decent fourth quarter. All indications are retailers will do as well as they expect. Maybe not a lot better, but certainly as well as they expect. Now, the other thing I want to tie into that is I read an article in the New York Times about the paradox of the U.S. economy. And the New York Times was picking up on some of those themes that, yes, on one hand, the U.S. economy seems to be doing okay. But on the other hand, people just don't believe it. Some of that's commodity price related. We've seen food prices, gas prices move all over the map. And it's very hard when investors are scared, when consumers are scared, it's very hard to get that confidence building. One of the things that can show us the fear, and that's in moving into the financial event area, is this VIX. The VIX index is something I've talked about time and time again. It's an over-the-counter traded ETF, or exchange-traded fund, and it tracks the volatility of the markets. The lower the VIX price, the more stable the market. The higher the VIX price, the more unstable. And that's frequently a sign of investor fear. Well, if we looked last week, the VIX had a midweek drop of almost 10% coming into Wednesday. That's pretty significant. But by Friday, it had come back up. Now on Monday just passed, we had a little bit of sell-off in the market, and that caused the VIX to bump up. But I think we all should learn to look at the VIX as an indicator of where volatility is going. If you have an equity portfolio and you're concerned that you might get behind it if it's going to sell off, well, take a look at the VIX and follow that. That could give you a bit of advance warning that problems are brewing. Last week overall, the Standard & Poor's 500 and the Dow Jones Industrial Average held about flat. They were both down very minor amounts. And I think part of that's the holiday weekend. People weren't as actively trading. But also part of it's because we're seeing the Dow at record levels, and people are a little bit hesitant to go in, but they don't want to give up just yet. We know, for example, as we go into 2015, the Federal Reserve is likely, very likely, to begin raising interest rates. Well, there's concern about what that will do to the market. So we're at this record level. We're kind of trading right around it, waiting for some trend to establish. As the fourth quarter comes to an end, if the numbers look good and we look like the first quarter will continue economic growth, you might see that trend go back on the rise. If, however, you see growth flatten out and interest rates go up, that market will sell off. Keep an eye on the VIX and keep your questions coming to questions@safefinancial.org. Now tonight, as I said, I'm going to be talking about the third rail of American politics, Social Security. If you're in your 20s or 30s, you hear every day that you're never going to receive it. You shouldn't even count on it. Why bother? It's not going to be there. If you're in your 40s and 50s, you're thinking, well, is it going to be there for me? And if so, how much? How do I find out how much I'm going to get back? Well, tonight we're going to look at the program as a total program, and we're going to look at some of the averages that you can expect as you begin to plan out your retirement. This is highly important for retirement planning, so we hope that you'll stick around after the commercial, and we'll be right back to talk about Social Security for the masters of money.
Have you ever gone online and Googled the words financial advice? When you do, you get over 3 million results. That's a lot of places that want to tell you what to do with your money. There are new websites that take your information, run it through their calculators, and generate automated financial advice with recommendations about how you should invest your assets and plan for your future. They're called robo-advisors. But they're not real advisors because they're not real people. Robo-advisors crunch data, then spit out cookie-cutter recommendations based on financial formulas they have created. Robo-advisors don't know your family, your history, or your personality. They don't know how you feel about your children or your charities. They don't understand what you hope to accomplish with your money. So here's the question. How can you trust financial advice from a source that doesn't actually know who you are or how you feel? You can't. Why? Because you are a person, not a number. You're an individual, not an algorithm. To get personalized advice, you want a qualified financial advisor who knows you, not a computerized avatar that thinks it does. You want an advisor with proper credentials and credibility, supported by an organization with compliant process and protocol. That's what we have. That's who we are. And we have the ability to understand you better than any computer program. Of course, we have the latest innovative technology too, but we use our technology differently. We use technology to support our expertise, not to replace it. We analyze, evaluate, and interpret your data to provide advice specifically for you. Advice about how to achieve your unique financial goals. Robo-advisors can crunch numbers, but numbers are only part of your story. The formula we follow puts you in the center of the equation, and that's exactly where you want to be.
Welcome back to the program, everybody. I'm anxious to talk to you tonight because, frankly, this is a subject that gets so much political spin. I think folks never know what the truth is. So we're going to talk about that third rail of American politics, Social Security, and we're going to try to give you all the facts you need to have the prosperity that you need. So anyway, here's a little background. You already know this, but let's set some of the parameters just so we know what we're talking about. As you know, it was created in the 1930s as one of the New Deal programs by Franklin Roosevelt. The problem that we had in the nation at that time is people had, generally speaking, no retirement. So it was very common for people in old age to retire from work, or to be put out from work, I should say, and have no resources on which to live. Now, that wasn't necessarily the government's problem at that time, but along with the New Deal and some of the changes that came in, Franklin Roosevelt and his cabinet decided it was necessary to provide income guarantees for all Americans so that retirement could be something enjoyed by people and not feared by people. This is, in effect, a system of forced retirement, if you think about it that way. Every one of us, man, woman, and child, when you generate a W-2 income, you have a withholding from it. They withhold 6.2% from you, and they force your withhold another 6.2% from your employer. So it's a 12.4% tax that's paid into a trust fund. The idea is that you pay in while you're working, and then when you reach retirement age, you've guaranteed yourself some retirement income. It's not a bad thought in concept. It does make people do something they otherwise don't necessarily want to do. So you can't argue with the intent. The reality of how it's worked, that's a little different, but we're going to go into that. For 60 years, though, you and I have seen this program work. Our parents, our grandparents, some of you watching may be on Social Security as we speak. This has been a program that has worked by building up a trust fund and then amortizing it out over the course of a person's lifetime. Now, there are some important dynamics. If you look at it today, it supports Social Security about 59 million Americans. That's an awful lot of folks. It's about 1/5 of our economy live off of some component of Social Security. That's a lot. Now, here's the key to that. If we look back when this program started, there were roughly 8 workers to every Social Security recipient. I'm going to put up the chart right now, a chart from the Social Security trustees, by the way. This is not politically spun. This is a chart right from Social Security. And it shows you that when the program started, going back to the 60s and 50s, it had 8 people per employee, or 8 workers per retiree, where today and forecasted forward, it's about 2. Well, that creates some economic problems. And the trustees of the Social Security Fund have outlaid those problems, or laid them out, in a number of reports, which I have actually read. The most interesting things about it show that going forward in about 15 years, the system technically will be broke. In other words, its its liabilities will outweigh its assets. I don't think you should worry too much about that. I'm going to show you why. Right now, in the trust fund for Social Security, there is about $2.7 trillion. Now, those funds, as you may know, are invested in very special government securities that pay a couple of % interest, but they're guaranteed and they move with inflation. The idea isn't to make money on the trust, it's not to lose money. That trust fund generates about 12% of the income for the overall Social Security needs. Right now, Social Security is about an $855 billion program. But it brings in $855 billion from payroll taxes and even out of that has a little extra today to put back into the trust. So right now the $855 billion going out is matched by the $855 billion coming in. Now part of that, again, about 12%, is interest from the trust fund. This is where it gets interesting. It is estimated by the Social Security trustees that we will begin to see an inversion of this over the next period of time, meaning that where right now the income is greater than the outflow, so we have about a 4% addition to the trust fund every year, that will transition. In fact, I think in 2014 it already has, to a point where there's no extra money to fund the trust. We're actually beginning to draw out of the trust to cover the $855 billion of expenditures. Now with that understanding, we're depleting down the trust year by year by year to the point that it is estimated by the trustees by 2033 the $2.7 trillion trust will be gone. Now that doesn't mean the system's gone, it means the cushion is gone. And we're going to talk about some changes that will be made to help support the system, and these are important for you to understand because they will affect you going forward. Now this next chart I'm showing you shows you where the deficit in Social Security is running. Right now, as 2013 approached, it was about 1% in deficit, meaning that the $855 billion, about $8.5 billion of that had to be taken out of the trust fund. As you go forward, you can see that it's increasingly in its slope. And the reason for that is fewer and fewer workers are paying in, more and more people are coming out. Look at the baby boomers. They are beginning to retire en masse. Well, as they draw Social Security, fewer and fewer people exist in the 20s and 30s to pay into it. So that's important. So you can state from this relatively clear, and I think without a lot of dispute, that at the current tax rate of 12.4% and the current retirement ages of 65, which for a full retirement 65, for full payout is 67, I think you could say that the system will be insolvent in 17 years and will be in big trouble. So we know that. Now, I mentioned a special tax note. A lot of people think their Social Security tax is only 6.2%, and that's not true. What happens is you kick in 6.2 and your employer kicks in 6.2 for a total tax of 12.4%. Now, if you're self-employed, you know that. Self-employeds pay a 12.4% tax right off the top. My point with it is this, though. You're paying for it. That 12.4% is your contribution. Don't think the employers are paying it out of their good graces. They're not paying you the same income they would be paying if they didn't have to pay that. It's a transfer of money. So it is a 12.4% tax, and that's extremely important. The other thing to note is that Social Security is unlike any other tax program we have, in that there's a cap on income up to which you pay into the Social Security trust. If you're one of those folks generating a six-figure income above $117,000, you pay nothing in that Social Security tax. So you get, in a sense, a 12.4% income increase. That's a nice benefit. It's always been like that, by the way. When Social Security started, that income cap stood at about $3,000. Now, interesting, I've had people say to me, well, isn't the $117,000 of today's cap just inflation adjusted for the $3,000 of the original cap? No. It's about this 117 is about 2.5 times the inflation rate. So what you've had happen over time is, in order to fund Social Security, the tax rate has gone up. We're now at 12.4, and that cap on which you pay benefits has gone up. We're now at 117,000. Keep those two things in mind. They're extremely relevant. Now, with that being kind of the revenue side and the fund side, what can an individual really expect out of Social Security? Well, if you look at the data, an average American earns $50,000 a year, give or take. After tax, that's $40,000. Their maximum benefit for that kind of income category is about $1,400 a month. Now, that's not bad. It's roughly half of their retirement needs, depending on how they'll want to live. The maximum benefit, if you've maxed out every year, is around $3,450, I think it is. So these aren't huge numbers, but they are a defined benefit. It's pretty nice to know you have. Again, go back to last week's discussion about the hybrid annuities. We talked about that giving you a defined benefit. Well, Social Security does that somewhere from $1,400 up to $3,400 a month. Not all bad. So let's talk about what we know. And these are just facts, and facts matter. Number one, we know that your benefit's going to be between $1,400 and $3,400, depending on how much you've kicked in. Number two, we know that there are a declining number of workers for an increasing number of benefit recipients. Number three, we know that we have a $2.7 trillion trust, but at today's levels, we're going to have that depleted within about 30 years. We know these things. And we know that the current retirement ages are 62 for pre-retirement, 65 for full or for normal retirement, and 67 for full retirement. Well, we know that these things have to change. Something's got to give. And you need to be aware of this. How do we plan for Social Security? I mean, there really are only a couple of things that can be done. Number one, we can increase the revenues. This would help the problem. And we can do that by one of two things. You can either raise the contribution level from 117,000 or 18, raise it up. Those of you who are my age remember when that was done to Medicare in the 1990s. Medicare used to be under the same cap as Social Security, and in the early 1990s that cap was taken off. So you now pay Medicare taxes on all of the income you generate. Well, that cap could be moved in Social Security. The second is to raise the level of contribution from 12.4% up to some number. Well, I'm not a gambling man typically, but I do understand how Washington works, and I'm willing to bet you to raise the income for Social Security. They won't raise the contribution level. That's political fire. But what they will do is raise that cap. So from 118,000, they'll take it to 150, or they may just take it off. That would be an enormous income push to Social Security and guarantee it for the indefinite future. The second side of things is to reduce benefits. Again, we're talking political hot potatoes, and there are two ways they can do that. Number one, they could tax the higher income recipients. So if you've put away money and you're living basically on your private resources, but you get Social Security as a bonus, they could say to you, you make enough, we're going to tax your benefits. The second thing they could do is simply increase the age for retirees. Again, if you're 20, 30 years old, I'm willing to bet you should be looking at 70 as your normal retirement, not 65 or 67. Well, that would also help the Social Security conundrum. So if you look at that, again, I'm not going to bet on which one, but if I had to, I would say that they're more likely to increase the retirement age for new entrants, 20-year-old, 30-year-olds, than they are to simply tax the benefits. And the reason I say that is Social Security is a trust. It's effectively an insurance program. You're getting back your money. Now, for the government to then come in and tax that would create a huge firestorm of protest, especially from older folks who are getting those benefits. So my bet is if you look at this on the increasing income side, they're going to play with the caps. And so if you make above $118,000 a year, be aware that likely coming down the line is an increase in your Social Security tax. On the benefit side, rather than taxing benefits or otherwise reducing the actual benefit, my guess is that the politicians to fix this are going to simply raise the retirement rate. And we've talked about that at the Master of Money. That's not necessarily a bad idea anyway. We are living a lot longer than we ever have. That's all good. Our productive lives go well beyond 65. So as we adapt into a brave new world, 70 is probably a more likely target for those of you starting out. So tonight we've talked about the reality of this program, and I think the bottom line is this. Yes, you can trust that Social Security will be there. That's not going anywhere. If anything, it will expand over time. They're going to keep it sustained by either raising that cap on the income or by raising the retirement age. I think they'll probably do both, neither of which would be cataclysmic on the economy. They would be marginally impactful, but they wouldn't be so cataclysmic as to cost all the politicians their jobs, which is why I think they'll do it. Now, if you'd like to learn about your Social Security benefits, you can go to Social Security's website. The government gets a lot of jokes about websites these days. Some of you may have followed those about a year ago. But Social Security's actually done a pretty good job. And if you go onto their site, I think it's ssga.gov, we'll put it up on the screen for you. The fact is you can find your specific benefit package. That's kind of interesting to know. It tracks your earnings so you can see how much Social Security earnings you've had in your life and how much benefit you can hope to enjoy. It's a useful site, and as you talk about building your retirement plan, when you talk with your advisor about how to fund this thing, Social Security is a relevant point. Now, the second thing, other than we think you should go there, build this into your retirement plan, and let me be specific. The average American making $50,000 a year, and let's say they want to retire with the exact same level of income and standard of living they've had, they need to generate about $3,500 to $4,000 a month in retirement income to sustain their life. Well, if we take Social Security as part of that, that's about $1,400. That leaves around $2,000, give or take, that they have to make up through private resources. Now, a prudent rule used by foundations historically is that you can spend 4% of your capital each and every year and still have a sustainable, in perpetuity capital base. What that means is if you have $100,000 in capital, you can draw $4,000 out without threatening running out of capital at some time. Now, if we use those numbers and we look at that average person, they're going to need to have somewhere around $500,000 put away to keep that 4% rule intact. That's a great deal of money, which most people today don't have. All the more reason we want you to share the master of money with your family and friends. Let's get 100 million people watching this program so we can help guide people to build that kind of wealth. We have to do it. This is a retirement problem that's going to hit us, and the way around it is to build private wealth that can support the retirements of millions and millions and millions of people. So we welcome you to invite folks to watch us here at the Master of Money. It's important to learn how to build that wealth. But if you're getting Social Security and you're 60, 70 years old right now, or 80 or 90, there's nothing to worry about. There's more than enough money in that system to care for you. If you're pre-retirement 50 to 60, plan on not a lot of change to it. You'll probably be able to pull those benefits out at 67 years old. You'll probably see the same benefit packages without reducing it based on taxing benefits or anything else. If you're 30, 40, or 20 in that age group, 20, 30, you might start thinking about some changes to the system. Most likely you'll see retirement ages bumped up to 70. Not a big thing. I think most people could live with that. And with that, you'd have a program that sustains itself almost indefinitely. So regardless of what you hear on the evening news, you can feel comfortable that Social Security as a program is funded and will continue to be funded. It's not going anywhere. Look at it as part of your retirement program. Now, as we go forward next week, we're going to have another program. We're probably going to get more into the nitty-gritty of investing again. We like to kind of move these things around. But as I've said, the Society was built to help you. It's a not-for-profit organization designed, engineered, and operating to help build a wealthier America through knowledge. We want to help you with that. So if you have questions, please write us at questions@safefinancial.org. Also, visit us on Facebook. We're at the Society to Advance Financial Education. On LinkedIn, we're The Safe Society. You can visit me on LinkedIn as well. Or that's Twitter, we're The Safe Society. At LinkedIn, you can visit me at Steve Beeman in LinkedIn. I'm easy to find. So we welcome you to have us join us anywhere you can to get the answers to the questions you have. So we look forward to seeing you next week. Join us once again as we present another Master of Money.